Okay, everyone, I'm back here with another episode. It's me, Jordan, the Millennial Investor, and we're going to go ahead and update these monthly numbers, what you guys wait for every single month. Let's go ahead and update this month on September 1st. Let's update our annual dividend income. We came in at $130.16 versus last month, $108. So if you factor that out, that's about $11, almost about 10 and a half every single month in passive income. Let's go ahead and look at this month's portfolio update on the value of the portfolio. We went from $3,033 to $3,738, so a pretty big jump up there. For the next update, we have our real monthly dividend income. That is a very slow month, the month of August, and the month of September is really going to look a lot better because that's when a lot of our dividend payouts come. August is a very slow month for us, but we did get $4 just for getting paid to sleep. And then last but not least, let's look at how my YouTube income did. Last month we got $234.83, and then this month we got a whopping $318.27, and that came from referrals to M1 Finance, that came from ads to my channel, that came from mentoring calls that I offer in the description of all of my videos. But overall, guys, all of these charts are doing steady up climbs. This is getting better and better every single month. I'm increasing my portfolio, I'm increasing my annual dividend income, my portfolio value, all that stuff. But overall, in this video, if you're not used to me, my name is Jordan. I'm the Millennial Investor. I am a dividend investor, and something that's great about me, if you can't already tell, is that I disclose every single thing in my videos that you could possibly imagine. If you're new to the channel, you get to see every single thing that I see. The only thing that you don't have is my login. You get to see all of my buys, all of my sells, all of my dividends, all of my decisions that I make in my portfolio will be shown in these videos. So overall, guys, if you want to help support me, my channel, and you appreciate the transparency, you see this number right here? You see this words that are highlighted right here? Usually this says give 10, get 10. Well, guess what M1 Finance just announced this morning? They're doubling up on their referral money on this little announcement right here. And I want to point this out real quick before I jump into the video. You see here that it says, thanks a billion. We passed 1 billion on our platform. Thank you for trusting us and putting our money to work with M1, and we couldn't have reached this milestone without you. That was on February of 2020. That was a huge milestone for M1 Finance, and it took them quite a couple years to get to that level. This is 1 billion in February, and now we are about to hit this in September. So in just a few short months, in what is that, 7 months, 6 months ish? In 6, 7 months, M1 Finance has doubled the size of money they have invested on their platform. And the reason being because people like me see the value that they have and they're referring people to M1 Finance. So if you want to hop on that bandwagon, I have 26 people referred. If you want to get now $20 just for signing up, not to mention you'll also be put in a drawing for $2,500 or an Amazon Kindle or a gift card or an M1 Plus membership. They are having giveaways as well as the $20. So go ahead and use this link. It's in the description. You can get that just for signing up. And everything is absolutely free from M1 Finance. So don't worry about any commissions or any fees or anything like that. Everything is free and it's a great platform to use. But overall, guys, let's look at this month. So in the month of September, we went up 5.73% on a money weighted return, about 190.44 in total gains, 180.30 coming from market gain, and $10.14 coming from earned dividends. Pretty good considering our total money weighted return is about 30% now, almost on the dot, and our portfolio is really starting to take off, guys. When I started this portfolio in April, I do these monthly updates every single month. It's just crazy the type of growth we're having. We started at $1,500, got up to $2,000, got up to $2,500, and now we're well past $3,000, almost reaching up to $4,000. And so let's look at the activity that I had for the month of August. So if you see here, we had my cash movements. I did get 2 referral bonuses for the month of August on August 14th. And then if we go to my deposits and withdrawals, I deposit $100 every Monday. So I did that every single Monday through the month of August. So that got me up $500 invested. Let's go ahead and look at my trading. I had buys every single Mondays that I deposited, and I had 1 sell from the month of August. I decided to take a profit on Microsoft. I made an entire video about it in the past, so go ahead and check that out if you haven't checked that out already. But I ended up selling my position in Microsoft, which was a smaller position, but I went ahead and took those profits and reinvested it right back into the portfolio. And like I said, this month was a very slow month for dividends, but we did receive dividends from AT&T, Verizon, NextEra Energy Partners, Realty Income, Procter & Gamble, Caterpillar, and Starbucks. And just to show the growth of this, I've showed this all the time, but I just want to show it one more time in case you haven't seen it before, showing the growth of this portfolio as far as the dividends go, what I focus on. You see how this keeps on going up every single month, the amount of dividends I receive. This is my monthly payer Realty Income. It paid 60 cents, then it paid 70, 71, 83, and now this month in September, I've already had that dividend claimed. It's at 83 now. If we go to my recent history here, yesterday they just claimed dividends. They claimed dividends of 95 cents yesterday. So you see it's went from 83 to 95, and it just keeps going up. I'm about to reach $1 every month in realty income, and then it'll be $2 and $5, $10, and eventually it's going to get to the point that it's ridiculous. But overall, guys, let's just go ahead and look at all 29 of my holdings sorted from greatest to least, and you can give your opinion on each and one of these stocks. And if you're interested in investing in my pie, this is shared down below in the description, so go ahead and check that out if you're interested. But let's go ahead and jump into the very first stock. Let's look at Broadcom. Broadcom is my #1 investment for a few reasons. This stock just hit an all-time high again literally today as we're speaking. Believe it or not, it's at another all-time high. $356 a share, and even at that whopping high share price, it is still giving a 3.4% dividend yield. When I first bought this stock earlier back in the beginning of the year when the recession was taking place, it was a 5+% yielder. I believe I bought it around $250 a share, and this stock has just absolutely exploded. They do share buybacks, they do dividend payments, they do dividend raises, which is coming up, I believe, in December. Yes, in December of this year. They have a great yield of 3+%, and I think overall with the semiconductor sector, and especially with Broadcom, with the amazing contracts that they have, especially with Apple, they just extended their deal with Apple through 2023. So for the next couple years, they are a software company, they are a hardware company, and they have recently acquired a lot of other billion-dollar businesses to increase their revenue streams, and they're still growing almost at double digits. They're growing about 8, 9% every single year, and I think that the stock is just an easy money stock, especially if you're a dividend investor. This will give you share price gains, this will give you dividend growth, this will give you pretty much everything all around. So I absolutely love this company, Broadcom. My next stock is 7% of my portfolio, up 36% on Realty Income. I've mentioned this stock a number of times, including just showing my dividends I made from it. This is just a stock that every single dividend investor has to own. You have to own Realty Income if you want to get into dividend investing. They pay dividends monthly, not quarterly, and they raise their dividends instead of annually, they raise it every 90 days. They raise it quarterly. You can see it's went from 19 cents up to 20, 21, 22, 23, and they just raised that every single quarter, and it is the easiest money stock to get because basically the way I look at it, they're diversified between 6,500 different properties. In my previous video, I went over this, but they have over 6,500 different properties. And if you believe over the next 100 years, if people are going to need homes, if people are going to need apartment complexes, going to need retail outlets, need agriculture to grow farmland, going to need office space to create businesses and create jobs, then if you think that's going to be a thing of the future over the next 100 years, then Realty Income is the stock that you want to invest in because they own the land and the buildings behind those, and Realty Income just gets money off those tenants and is going to be a long-term success story. Next is 6% of my portfolio, which is a long-term growth stock, which I think is growing at a rapid pace and not going to slow down anytime soon. And it is the lowest yielding stock in my portfolio. It yields a whopping 0.5%. And this stock has just hit its all-time high just recently, just the other day. It got up to $216 a share. And Visa is a stock that I think has so much more potential ahead of it. Now, it's easy to look at the stock that says $400 billion and say, okay, it's probably near the end of its rope. It probably is near the end of its growth story, and it's probably going to start slowing down. Well, I want to point out something to you that I mentioned in all of my videos with Visa. Anytime I bring up Visa, you think about how incredible their ecosystem of products are. You think about how sticky the customers that have Visa are with their credit cards and debit cards and mobile platforms. You think about how awesome the margins are with Visa. Well, I got some news for you. Globally speaking, 85% of the world's financial transactions are still done in cash. So you think about how large this company is, how profitable they are, tens of billions of net income, and you think about that, and then I want you to realize that this company has only tapped into about 15% of the global market. 15%. They literally have so much opportunity that they hadn't even been able to reach yet in the global markets and all those foreign third world countries that are a little bit underdeveloped and don't have credit and debit card machines yet. I think when that begins to happen over the next 10, 20, 30 years, I think that Visa is going to have so much more opportunity ahead of them. And so Visa, in my opinion, I think it is just a great buy for the long term. 6% of my portfolio goes into the Southern Company. I'm almost break even on it. I'm down a whopping 2%. And when we're talking about the Southern Company, I just think that it is such a basic, retired, old person stock. This is not a stock that's going to be hitting the news every single week because they are a boring utility company. And that is exactly what I want. I want boring. I want slow. I want dragged out. I don't want a stock that has a bunch of drama going on. This is a stock that barely trickles up in share price over the next 5 years and will probably do that over the next 5 years after it. It's government regulated, and basically the way I look at it, people are always going to need to pay their electricity. If they do that, then this company is going to keep its whopping 5% dividend yield as well as its annual increases, which it already increased this year, even in a recession in 2020. So Southern Company is an easy money stock that's a utility stock. Next up, we have a position that I just increased my position in. It's 5% of my portfolio. I'm up 31.42% on it. And Caterpillar is a stock that I really have a lot of ambition for over these next couple years. It's came down a lot in share price. It's starting to recover somewhat, but I think that they're holding up on the dividend raises this year so they can get more capitalized for 2021. And I think that there is rumors of an infrastructure bill. If Trump gets reelected in 2020, I don't care who you're supporting, I'm just telling you what he's going for. Trump is really pushing this infrastructure bill. If it goes through, this will be the number one benefiter of that bill will be Caterpillar. Caterpillar will more than likely skyrocket in price from all the new orders and all the new revenue streams that they'll be getting from this infrastructure bill. I think that Caterpillar is an easy money stock, not only from the infrastructure bill, but from their original business as well. Even if that never goes through, they have great margins, they're trading at a great valuation at only a 19 PE ratio, and they're offering a 3% dividend yield in the meantime. They have great dividend growth over the last 5 years from 77 cents all the way up to $1.03, and I think that this is a stock that a lot of people should own for the industrial sector. Now, as far as easy money stocks go, Pepsi is definitely one of them. It is up 11.13%. It is 5% of my portfolio, and I went over in the previous video all the different brands that Pepsi has to offer. Whether we're talking about Doritos, we're talking about Quaker Oats, Pepsi, Mountain Dew, Gatorade. There are so many different brands, and you can see some of them listed right here. There's a lot. There's about 40 different brands, if not more. There's 40 plus brands that diversified this portfolio of products for Pepsi, and these are brands that I'm sure a lot of you watching drink or eat every single day, if not most days. They capture such a large part of the global market, and as the population grows, as they continue to raise prices on those brands slowly over time, they'll continue to be more and more profitable and then buy out smaller brands as well. Pepsi is just one of those stocks. If you believe that people are going to need something to drink and need snack foods to eat over the next 100 years, then Pepsi is the stock that you should be buying. And the same thing goes for Coca-Cola. 3M is another industrial company that I own, which I always love to mention. It's 5% of my portfolio. I'm up about 20% on it. I just increased my stake in 3M this past month in August, and it is pretty much flat over the last 5 years. And this is one of those stocks that is so diversified that you almost can never lose money on it in the sense that it has 56,000 different products, and of those 56,000, a lot of them are profitable, a lot of them are growing every year. So regardless of how good or bad some of their products are doing, they have so many in so many different categories that pretty much as the economy grows, 3M is going to grow with it. They have a great dividend track record of over 50 years worth of growth, and they already raised it again here in 2020, in the beginning of 2020, right before the recession started, and I think that they'll be raising that next year in 2021 as well. In the meantime, while you wait for that share price to get back to normal, you'll get a 3.5% dividend yield, and I think that 3M is a great industrial company. Of all the industrial companies out there, 3M might just be the best one to buy. JP Morgan Chase, the world's largest bank, 5% of my portfolio. I have increased my position in this in August 1, 2, 3 different times in the month of August. I have taken this from a 2% holding in my portfolio to a 5% holding in my portfolio. It is the one by far that I have beefed up the most, and I started buying this stock heavily in the 90s, about $95 a share on average, and this is a stock that I am definitely still bullish on, even in the hundreds. If this is 100, 110, 120, I still think that this is a great stock to be buying. Not only because they have great dividend growth, they have an awesome track record, this is one of those business models that are always going to be around. Do you think that people are always going to need banks? Of course. Do you think that people are always going to need to get home loans? Do you think that people are always going to need to get credit cards? Do you think people are going to need to have checking accounts? Whether that be in person or mobile, whatever the case may be, people are always going to need banks in some way, shape, or form. If you believe that, if you have a bullish sentiment like I do on banks, why not bet on the world's largest bank? Why not bet on the bank that has $30+ billion of net income and a 3.5% dividend yield? JP Morgan is one of those stocks that if you're wanting to get in the financial sector, you got to own JP Morgan. Next stock, we have McDonald's. It's 4% of my portfolio. I'm up 32% on it currently. And McDonald's is one of those stocks that they are the largest restaurant chain in the entire world. And if you believe that people are always going to need somewhere to eat and you don't think that fast food is going away anytime soon, then McDonald's is probably going to be around for the long run. Some cool piece of information, they do raise their dividends every single year. So about 2 months from now, they're due for another dividend raise because they are currently paying $5 a year in dividends previously from its $4.80 a year in dividends. And they raise that dividend every year, and they have a huge track record from dividend growth and as well as share price growth as well. You can see in the last 5 years, it's already nearly doubled up. And McDonald's, I'm sure you all know and love it. And the way that they end up targeting children gives them customers for not 10 years, not 20 years, but a lifetime. As people fall in love with them, with their toys, with their french fries, their nuggets, whatever, people fall in love with them and then end up buying their products for decades and decades out, usually a lifetime. So McDonald's, one of those stocks that I am betting on to be successful in the long run. Coca-Cola, I won't go over it. Pretty much the exact same thing as Pepsi. I am up 12.61% on it. It's 4% versus Pepsi's 5%. Coca-Cola only offers beverages. It does not offer snack foods, but pretty much the exact same story as PepsiCo. And speaking of exact same stories, WP Carey is a very similar story to Realty Income. If you believe, once again, that people are going to need office buildings, agriculture, WP Carey is a stock that anyone should own if you're bullish on real estate in the long run. And one cool piece of information about WP Carey over Realty Income, they do raise quarterly, just like Realty Income does, but they don't pay monthly. They only pay out quarterly, once every 90 days. But this stock has an incredibly high yield of 6%. If you're buying the stock today and they're able to maintain that dividend, which I'm betting that they will be able to, they have a great track record, then they have a 6% dividend yield that you are locking in today. So overall, great move. This was the only stock that I lowered in my portfolio in this month of August and leading into September. I will be holding this. Now, Whirlpool is a stock that I own at $86 a share. Now, when I first bought this stock, I ended up buying it for $81 a share. I've increased my cost basis. Now, when I bought this stock at $80 a share, this was a much different valuation than what it is today at $178 a share. It is doubled up from the price from where I originally bought it. You see, I bought it originally on April 3rd, right here, 82. I bought it for 81 and some change. And you can see it has been a skyrocket up. At one point, it was about $185 a share. And this is a stock I'm still bullish on for the long term. I don't think the valuation is as good as it was just a couple months ago. If this goes up to, say, $200 a share or more, I will probably end up selling it. And I've even considered selling it at these levels, but I have lowered my position in it just to go ahead and reduce my deposits because this stock has came up a lot in valuation. That said, they are a very safe, stable dividend stock, paying nearly a 3% yield, and I don't think that they're a sell. They're a pretty solid company, so Whirlpool is a good one to invest in as well. Speaking of stocks that are up a lot, let's go ahead and look at a stock that I'm up 80.8% on. 3% of my portfolio, Discover Financial Services, is a stock that's very similar to a Visa from their credit and debit cards. It's kind of like if JP Morgan and Visa had a baby in some way, because Discover Financial is definitely focused more on the banking sector, but they are growing quite a bit faster than a lot of the other large banks out there because they are focused on a lot of things like mobile platforms and credit and debit cards. Discover has their own mobile payment system, and I love their credit card. By the way, shout out to the description. If you want to sign up for a Discover credit card, they have an amazing beginner credit card if you're watching this. If you have low credit, if you have no credit, if you're a college student, they have great options for people that are just getting started out. And I have 3 credit cards, and they're the one that I started with. And not only that do I think they're a very financially stable, healthy company, I love them as a consumer. My experience with Discover as a customer has been incredible. The customer service, the platforms that they have, the customer ease of using their platforms and getting the rewards. I think that Discover Financial is a good stock for the long term, and you're getting a 3.3% yield. Now, I talk about these two stocks a lot. I talk about Procter & Gamble and Johnson & Johnson quite a bit, and I've considered bumping up both of these positions, even though they're both at all-time highs. This is a stock that you should not be worrying about the share price. This is a stock that you should be buying year in and year out, no matter what the share price does. The only thing that should ever change, if the share price goes down, you should be buying it more. When it comes to Procter & Gamble, the brands that they have are so incredible and so easy to use that nearly every single person in their household uses these products. You can see some of the names right here. They have things like paper towels, tissues, laundry detergent, toilet paper, feminine care products. There's a number of different products that they have, and these are just basic household items that every single person takes for granted, and they get profits off of those, raise their dividends, and increase their business every single year. And I think Procter & Gamble is going to continue to be successful in the long run, and this is a very old company, and it's going to stay alive, and so will Johnson & Johnson. 12.37% is what I'm currently up on it. It is 3% of my portfolio, just like Procter & Gamble. And when you're buying Johnson & Johnson, in a way, it's almost like buying a healthcare ETF. They're diversified between any and everything healthcare. And when you're buying Johnson & Johnson, you go from as high up to $100,000 surgical equipment all the way down to $1 Star Wars Band-Aids. I always like to give that example because they go from the extremely high end of healthcare all the way down to the very bottom low end. Any and everything that's involved with healthcare, you've probably seen Johnson & Johnson and probably used them a number of different times. They keep on reinvesting into new healthcare products, and they're extremely profitable in everything that they have. Johnson & Johnson has been around for a million years, and I think that they're going to stay around. And speaking once again, a very old-timey stock that continues to be profitable off of household products, I'm up 19.15% on it, 3% of my portfolio again, at all-time highs. Kimberly-Clark offers a bunch of just basic paper-like products that once again you use every single day. A lot of diapers, a lot of Kleenex, a lot of paper towels, napkins, things like that. If you're investing in Kimberly-Clark and you believe that people are going to use those products, then they're the largest distributor of those toilet papers and of those napkins and of those other types of products in the world. So investing in Kimberly-Clark is guaranteeing yourself a 2.5%, a 3% return just off the dividend by itself. Now next up we have waste management. When you make trash and you take out that trash, where does that trash go? Well, more than likely, waste management could be the one that takes it out for you. If you ever see those big green trash trucks that say think green, think clean, those are waste management trucks, and they're powered by natural gas. They have such sticky customers that they usually have contracts for people, whether it be the governments or communities or whatever the case may be. They usually have contracts for people decades out. And basically, the way I look at it, people are always going to create trash. We might create more, we might create less in the next 10 years, but basically, people are going to find ways to create trash and create waste, and waste management is going to be there to clean it up for you. So why not invest in their company as they capitalize off of your trash, and then you can get a piece of the profits back in the form of dividends and their share price going up. There's a reason the stock has doubled in the past 5 years and continues to raise that dividend significantly. I don't think that is going to be slowing up anytime soon as the population grows and people become more wasteful, so waste management is a good investment there. Altria is a stock that is the highest yielding stock in my portfolio. I'm currently up 20.85% on it. It is 3% of my portfolio. I did bump it up in the month of August. And this stock is down over the last 5 years because they own a huge stake in Juul, the cigarette pods. And they have all different types of tobacco products with cigars, with cigarettes, and other things like that. And basically, I don't think that this stock will innovate very much. I don't think that this stock will be growing rapidly over the next 5 years. But I do think that they will be able to maintain a whopping 8% dividend. When I was buying the stock, when I increased my position in it, it was actually almost a 9% dividend. I was buying it about $40, $39 a share. This stock is a stock that I think will be able to maintain that heavy dividend, and even if I'm wrong, they're not a huge bet, so it's not going to really hurt me too much either way. But I think that Altria will be able to hold that dividend for the long term. Another real estate company, pretty much the same thing as WP Carey in Realty Income. This is once again Store Capital, a real estate investment trust. And basically the only difference here with Store Capital, they do not base clients off of their credit rating. They base them off of their financials. So that's the one little twist here to Store Capital, but basically they're doing the same thing as WP Carey and Realty Income. And Store Capital, I think once again, real estate sector, I'm very bullish on. Qualcomm is a stock that has went up a lot over this past month for me, as you've seen. I'm up 85% on it. It is 2% of my portfolio, and Qualcomm will be taking advantage of 5G, just like Broadcom will, and their number one customer is Apple. They announced this actually in this big spike up here back in early 2019. They have very long contracts with Apple. They will be increasing those dividends. They will be increasing profits. And I believe that over the next couple of years, when 5G really gets ramped out, Qualcomm will really start to take off. That is a stock that I think for the next 5 years will have great share price gains. Starbucks is a stock that you all know and love. 14% is what I'm currently up on it. 2% of my portfolio. while they don't have the largest economic moat on the planet, they definitely have pretty good share price growth, overall great revenue growth. They own, not franchised out, but they physically own over 90% of the stores that they have, and they have fantastic dividend growth over the last couple of years. And I think that will continue as they transition more from a growth company as they want to find ways to reward shareholders. So I think that this 2% yield over the next 5 years will transition probably into a 3% yield, maybe even a 4% yield. So Starbucks is a stock that I'm very bullish on as they target millennials and Gen Z, so they will very much be profitable for the future. Honeywell is another industrial company, pretty much the same story as 3M. They produce thousands of different products. I'm up 26% on it. And basically with Honeywell, once again, they just got added to the Dow. If you believe in the Dow, then you believe in Honeywell, because the Dow just decided that it was going to add Honeywell in replace of another company into the portfolio. And Honeywell, just like 3M, as the economy grows, I think they'll be growing with it. And they are due for another dividend raise in 2 months from now, in November. So overall, Honeywell is a great growth stock that is in the industrial sector. Home Depot, I'm currently up 55% on. It's 2% of my portfolio. I considered adding Lowe's and Home Depot, but I just went ahead with Home Depot. And this stock has exploded, if you can't tell. It's over doubled in the last 5 years. It has went from 59 cents every quarter in dividends all the way up to $1.50. Almost tripled up in the last 5 years. That is huge dividend growth. And still, even at the skyrocketed prices, you are still getting a 2% dividend yield. So even in my opinion, believe it or not, as high as Home Depot is, it's still a buy. I'm still buying the stock at all prices. Verizon is a stock that is very similar to AT&T in the simple fact that they just have a steady recurring stream of revenue from their profits from their mobile platforms. They're a telecommunications company that just barely raises dividends every single year, and they are giving you a 4% yield in the meantime. Verizon is those stocks that doesn't renovate a whole lot. They're not going to really change or grow a massive amount, but they do have steady, stable business growth, and they will continue to raise that dividend, I think. Same thing as a Southern company mentioned up here, one of my largest investments. I think that Duke Energy is pretty much the exact same business model, steady, safe utility income, and I think as it gets regulated from the government, as they're allowed to raise prices and the population grows, Duke Energy will do the same thing as the Southern company. They'll raise that dividend and grow the share price pretty much every single year at a gradual amount. Cisco is a stock that has a very long track record of dividend growth. They're a dividend aristocrat by far. They have nearly a 3% dividend yield, and the stock at these levels are still a pretty good buy as it is well off from its all-time highs. Basically, if you've ever ate food at a restaurant or a cafeteria or anything at the sort, Cisco has probably delivered at least some, if not all of the food to that restaurant. Cisco is the middleman of getting the food from the farmland to the restaurant. That is what Cisco do, and they are the largest distributor of food in that category. NextEra Energy is a stock that I'm up 50.45% on. Once again, 2% of my portfolio. It is the only energy company in my portfolio that I own. They are focused strictly on renewable energy. They're not big oil. They're not a bunch of fossil fuels. I think that if I'm going to invest in anything with energy, I have to invest in renewable energy. So that's my bullish thesis with NextEra Energy. They're growing that dividend with this stock every single quarter, and they're growing it massively. And even at these all-time highs, they're still getting a 3.5% yield. I think NextEra Energy Partners is a great stock to own. And then I have these two bottom stocks here. AT&T, much like a Verizon, which I'll be going over AT&T in my next video. AT&T is very much struggling, but they have an extremely high dividend yield. You can see I sold off a lot of my position in AT&T and IBM back in June, and I think that these stocks are not very well capitalized for the future, but if they're able to maintain their dividends with their slow dime business models, they have great dividend yields. They're both turnaround plays. I think that there's a good chance IBM will be able to turn around their company with their new CEO and their new growth opportunities. But if that said, if they're not able to keep it, it's not a very large part of my portfolio. It's a whopping 1%. But if they are able to keep it, you're getting a 5 and 6% yield with AT&T and IBM. So those are my two reasons for owning those. But overall, guys, that is all 29 positions in my portfolio. If you have any questions down below, go ahead and leave them down below. And once again, like I said, it's usually $10. We now have $20 for a referral. All you got to do is open up the link, sign up using my referral link, and then deposit $100 to the platform, and you'll get $20. $20 just for signing up. So go ahead and do that if you haven't done that already. I'll continue to disclose everything, show all my positions, show why I'm doing it. And overall, guys, thank you guys so much for watching all the way to the end. I really appreciate it, and I'll see you guys next time.